general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. Now, Property Monday continues as Margaret Lomas and her team answer all on Your Money, Your Call.
Hello and welcome to the Monday night edition of Your Money, Your Call. And you know, if it's Monday, then we're talking all things property. I'm Lisa Montgomery, filling in for Margaret Lomas, who'll be back in the chair in a couple of weeks. And tonight, we have another great show full of property news and discussion for you. And of course, as usual, we'll be taking your calls and answering your emails to help you make better decisions regarding your personal property investing journey. Now, to kick off tonight's program, I'm joined by regular guests Rich Harvey from Property Buyer and Ben Kingsley from Empower Wealth. So, with these two experts in the studio, it's a perfect night for you to ask a question. Now, as always, we invite you to be a part of the discussion, indeed a very important part. You may want to comment about one of the issues of the day or have a question for one of us on the panel. And if that's the case, then pick up the phone and call us right now on 1330 34 35, or you can email me right now on property@skynews.com.au. Welcome to the program, and let's start with some news. And according to Fairfax, housing is among the RBA's key economic uncertainties. Housing and household consumption has been highlighted as one of the key areas of uncertainty with regards to accurately forecasting future economic trends. In the Reserve Bank of Australia's quarterly statement on monetary policy, the bank listed how developments in this area would affect the economy overall. Echoing RBA Governor Philip Lowe's speech last week, the statement warned that higher levels of household debt meant that households are more sensitive to deterioration in expected income growth, which could come from factors such as rising house prices. If indebted households believe that their prospects for income growth have weakened, they could choose to pay down debt faster and consumption growth could be lower than forecast. Although rising house prices in Sydney and Melbourne could see more spending and renovation activity in the short term, continuation of this trend could result in further risks in the medium term, the RBA said. So, welcome to the program tonight, gentlemen. How are you?
Well, Lisa. Great, Lisa.
I always love working with you too, so I'm sure it's going to be a great show tonight.
Sure it will.
This is an interesting statement by the RBA, and they are concerned with household debt and the rise in household debt. And I think rightly so too, given that we've had masses of equity that people have naturally obtained through property ownership, and a lot of those people have really leveraged that equity to get into other property and other asset classes. So I guess there is a real concern. But I guess, Ben, from your perspective, is it something that we as homeowners, as landlords, should be concerned about?
Yeah, we should, because we're interconnected in the market, aren't we, Lisa? I mean, if we've got $33 billion worth of credit card debt out there, that is a real concern in terms of what it's going to look like. So the way in which I look at this is, if we start to see mortgage stress and what I call the wealth effect, where people are concerned about their jobs, they don't go out and do their retail spending, that has a flow-on effect in terms of confidence, which then affects sentiment and ultimately property prices. So as landlords and investors, we absolutely want to be in areas where other people aren't stretched to the maximum, because if we have a flood of those people come onto the market, our property price is going to fall.
From your perspective, when you're talking LVRs with some of your clients, do you try and keep that LVR under 80% on their principal place of residence, or is it something that you let the landlord decide? Yeah,
ultimately, as a qualified property investment advisor, the first thing I'm looking for is objectives and risk profile. So I'm trying to work out exactly where the client is in their accumulation phase and how much risk appetite they're willing to take on. So as a general rule, I'm naturally conservative, so I'd love to see LVRs, no greater than 80%. But if I've got a young couple, professional couple with really strong growth around their story of income, and they've got confidence and they're willing to take that risk, then I need to accommodate their best interest, even though I might have a bias to try and give that lower LVR.
Yeah.
At the end of the day, I work for the client, so it's ultimately about meeting their expectations.
Rich, do you have a different view? I mean, is this a Melbourne-Sydney thing, or is this a whole of Australia issue?
Well, just in terms of what Ben's talking about LVRs, I tend to agree with you, Ben. I'm naturally probably a bit more aggressive, but it depends on where the client's at in terms of their accumulation phase. If they're fairly young, they're on good incomes, it's that issue, do you pay mortgage insurance or not? I've paid it several times and I've got into the market and done well, but I think it's an individual thing. So,
yeah.
But in terms of is it a Sydney-Melbourne thing, I think, look, any household that over-leverages themselves is going to get themselves into hot water. I think what's happening now is some good warning shots being fired over the bow by the Reserve Bank saying don't over-leverage. We've all had this fantastic low interest rate environment, and the natural reaction to that is for people to leverage high and leverage hard. And why not? We all save our money, but leveraging into property is a good, safe investment, but not every investment performs the same. So people can over-leverage at this stage of the cycle, get themselves into hot water and sort of anticipate, but the property will grow 10%. It'll grow 10% next year. Well, it probably won't.
No.
Because the market cools, as the market settles down, people have just got to watch how much they're spending on their debt.
And we are seeing the market cool. I mean, we saw those auction clearance rates for Sydney this weekend, probably the lowest we've seen in a while. I don't know if that's a sign. I don't like to generalise about, the market in Australia as one market. We've said that before, but is it a sign, though, Ben, that we're seeing some cooling in Melbourne as well?
I hope so. I mean, we can't sustain the level of growth that we've had. This has been one of the longest cycles I can remember. Like, we're talking about a growth cycle of 4 to 5 years, 5 years in Sydney, 4 years in Melbourne. Those types of cycles are just incredibly long. So from our point of view, it is about sustainable and sensible investing. And what we had in places like Melbourne and Sydney is this FOMO, this fear of missing out. And credit to the RBA, who have gone behind closed doors with APRA and ASIC, and they've sort of said, look, we can't take a sledgehammer to this because it'll destroy the economy. I mean, we saw what happened in the US with regards to, the GFC. When the property market fails, the entire system is unstable. So when you start to see this scalpel approach, where we are seeing, making it a little bit more expensive for investors to get into the market, making principal and interest loans a little bit more attractive than interest only, we understand that that is what they need to do at a macro level. In terms of each of the households that we look after, it's going to be case by case, but I do like the idea that having 50% of the marketplace being investors, that worries me. So for me, I think we need to take a breather, and hopefully if it's a softer landing rather than a hard landing, that's good for the economy overall.
Definitely.
Rich, the regulators have really, I think, done a fairly reasonable job in the last 24 months with a lot of the restrictions that they've placed. But I guess I am significantly agitated by the lenders at the moment who have taken the opportunity to increase rates for existing borrowers and not just for those new people coming into the market. I don't know what your clients are saying to you.
Definitely some price gouging going on, and happy days, profiteering if the APRA's sort of putting the brakes on. Well, hey, let's just bump up some rates a little bit more than we need to and make it harder. So definitely, look, a lot of our clients are struggling. Not all of them, but we're seeing that those that can get loans, can still afford to get loans, are still getting good results.
Yeah.
Those that are on the sort of borderline income levels that perhaps could borrow 500 are now being scaled back to 450, 400 instead of... But they can still buy a property. It's not you can't borrow money to get a property.
Yeah.
It's just the amount you're able to borrow and your serviceability is really being tested. So that's what we're seeing in the market. But I think there's also a flow-on effect to this. I was talking to someone today who does financing for development sites, and one of the unintended consequences of APRA is when they're shrinking or trying to constrain lending growth, all the banks are pulling back from developments. Now, that's going to make it harder for supply to increase.
Yeah.
And what happens when supply is constricted? Well, prices go up. So I think APRA's right to constrain credit growth to individual investors, but I think the bank should also look at allowing more funding for development because that's what needs to improve. We need more supply on the market to see property prices come down.
We do. Ben?
Yeah, look, we've got to look. I mean, there is anticipated an enormous amount of supply coming on in the next 12 to 24 months. Like we're talking about, say, Brisbane as an example, we're talking about 15% growth in the next 12 months. So, and almost a quarter of their current stock being increased by a quarter more stock than what we've had. So obviously Brisbane is one to watch on the downside risk. But what we are seeing is definitely the appetite in Sydney. It's being fully absorbed. We're not seeing property prices being underpriced after the, buying off the plan. And so APRA did consider dropping that speed limit down to 7%. But to their credit, they've kept it at 10%, purely because there's obviously a flow-on effect of all of this purchased property, contract signed 2 years ago, property's going to be finished in 2018. These people need to be able to get funding because that will again have, a detrimental effect to the actual overall economy and the marketplace. And, it's amazing the amount of industries that are connected directly and indirectly to property. So
absolutely. We just, like you said before, we don't want a sledgehammer approach.
No.
We need really careful policy.
Correct.
Because we just need a softer landing. We don't want a crash landing with this property market.
Absolutely.
Because the property market, the multiplier effect, the amount of people employed and the spin-off benefits from all the industries around the housing market is just phenomenal.
Yeah, that's right. All right, let's answer our first email tonight, and it's from Christy. And she asks, I'm just wondering if you have any tips on what types of property to buy in Waterloo, New South Wales, given it's a high-density area with lots of development. Or would you recommend staying away from this suburb? I already have one apartment that's doubled in value since I purchased it in 2014. OK, now we've got a couple of minutes to answer this. She already has a property, so she knows that it's performed. Rich, I'll come to you first. I mean, she's got one there.
She's got one already. She shouldn't buy a second there. Look, I think, Christy, you've got to diversify. You've done really well getting one property, and doubling in value since 2014 in 3 years is a pretty good result, I've got to say.
It's incredible result.
I'd certainly be saying stay away from off the plan in Mascot, Zetland, Waterloo at the moment. There is an enormous amount of supply yet to come on, and including Green Square, another 30,000 dwellings coming in there over the next 10 years, Lisa.
30,000?
Yeah, there's a huge number. Don't quote me on that, but that's I think one of the numbers that I've seen. But what I'd be looking for, Christy, is really trying to find, if you are just set on that area, then look for a property that is going to be rezoned or has some value-adding potential.
Yeah.
I mean, some of the outskirts of the city areas, like Redfern, Alexandria, there's some great little pockets around there where you can buy a renovator's delight and buy something in there. So there's certainly opportunities, but I wouldn't be buying again off the plan. You're just paying developers margin, and you certainly won't be doubling the value in the next 3 years in that area.
Good advice.
I concur with Rich. It's exactly the same. So, yeah, no, Christy, it's crazy to think that you need to put all your eggs in that basket. I mean, how many times have we seen clients who, I bought one, went really well, I got another one, and then I shouldn't have got that last one because I bought it at the top of the market. Right. Whereas if I had bought that one on the Gold Coast or the Sunshine Coast or wherever, when the market was actually on the uplift. So, yeah, we'd be saying spread the risk. It's really important to understand that. In those types of marketplaces also, and if anyone's looking to get into a high-density market, try and do some research to get an idea. Best way to do is maybe look at one of the search engine portals and just put in 1 bedroom and then search, and you'll get a number available for sale. 2 bedroom search, 3 bedroom search, and you'll start to understand the supply side of what's in that particular market. Now, for novices, that's a great way to do it. Obviously, you can speak to professionals who will guide you in the right direction. But if you are just starting out, they're the types of things. And you can also look at the ABS data and get the supply data on there as well of what's coming online.
Very good.
Again, another opinion and a good one for Christy. So thank you, gentlemen. Well, thanks for tuning in. And even though she's not here tonight, we'll be still giving away 2 of Margaret's books to the questions of the week. Now, the panel and I will choose 1 question from the emails and 1 from the calls, and those people will receive Margaret's book, How to Achieve Property Success. And if you're ready to invest, this book will make sure you tick all the boxes in relation to the process. So all you have to do is call us tonight on 1300 30 34 35, and nobody has yet, so I am expecting your call, or you can email property@skynews.com.au with a question. Then make sure you watch at the end of the show to see if you're one of the lucky winners of Margaret's book. Now it's time to take a short break. Don't go away. When we come back, we'll take some more calls. We'll have to maybe take a call and answer your questions. Welcome back and thanks for joining me for Your Money, Your Call Property. I'm Lisa Montgomery, filling in for Margaret, and joining me this evening is Rich Harvey from Property Buyer and Ben Kingsley from Empower Wealth. So don't waste any time, not a second. Call us now on 1300 30 34 35, or of course you can email us on property@skynews.com.au. But Peter has called, and Peter, you're on the phone and you're from Sydney and you've got a question about property brokers. How can we help?
I was wanting to ask, how would the panel suggest to start a property portfolio? Would you buy all your properties in your own state or diversify? And are there brokers the panel would recommend, and what price range would you recommend to start your investment property portfolio at?
So Peter, you're starting out. This would be your first property?
No, I have other properties, but I was just wanting to find out it. Yes.
And property brokers, that term's not necessarily one used widely in Australia. Are you talking about somebody who will source those properties for you?
I'm for property brokers that do home loans.
Oh, okay then. Property brokers.
Finance brokers.
Finance broker. So more of a finance broker.
That's right.
Okay, great. Okay, I'm going to go to the panel and we'll see. There's a couple of parts to that question.
Let's start off from the start. Peter, how do you start a portfolio?
Yep.
First of all, you talk to a finance broker. So,
yes.
Lisa, I'm sure you can recommend some good finance brokers.
I tend not to do that, though.
I think, Peter, before you start anything, work out your borrowing capacity and also work out your goals. I think it's really important that you sit down with an independent professional and just work out what is your strategy, work out what you can borrow, because that's really important, and then you can start doing the research and going shopping, because a lot of people just go out there, jump on Real Estate or Domain, start looking at properties, and they like the pictures or like the views, and then start making offers without doing all that fundamental research on what makes a good investment property, Lisa. I think that's really important. So number one, get a good finance broker. Secondly, get some help on working out a strategy, and then you could work with someone like Ben or myself as a buyer's agent and recommend where to buy. And I think that was the third part of his question.
Yeah.
What areas and price range should you work in? And I think, look, Peter, you don't have to spend $1 million on your first investment property. You know, if you've got somewhere, say, between $250,000 to $500,000, you can buy a good quality house that's going to get you a 5 to 5.5% yield, and it's going to grow at 7% per annum. You know, those sort of numbers will really kickstart him along on his journey, and we can recommend a number of areas to support that.
Yeah, no, that's sound advice. Ben?
Yeah, so Peter, if I put my Property Investment Professionals of Australia chairman's hat on, I'm obviously going to tell you to go and speak to a qualified property investment advisor. They are formally educated to be able to provide property investment advice. Now, when they sit down with you, they should be able to look at your goals, outline those goals, and then try and make an appropriate recommendation based on your financial situation, your cash flows. Now, they'll need to bring a team of people together, potentially, and that could include your broker or your banker. That could also include your buyer's agent, such as what Rich is, and in terms of, you know, how they work together, and also the accountant as well. So you really want to build a great team around you to be able to be in a position where you can sensibly plan out what you're trying to execute on. In terms of what Rich was saying before, I totally agree that looking at property is not researching property. So it's really important to understand that there are some science to trying to buy in the right area at the right time. And so getting all of that together is a really important step. And I'm a big fan of being a borderless investor. So in other words, not just investing in your own backyard. At the end of the day, we're talking about a financial return here, and it's through bricks and mortar. But that's all it is. So if they align with your goals, align with your cash flows, they should solve the sort of purchase price point that you're looking at. If you're chasing growth, if you're chasing a balanced property, or you're chasing a yield property or a value-add property, all those things should be explored when you sit down with a professional advisor. Once you do that, the information becomes clearer, and as I always say, it makes the invisible visible.
Yeah, no, that's a good piece.
And I'll just back up exactly what you're saying too, Ben, about don't just buy in your own backyard. As Ben said, you can buy borderless. You know, don't be afraid to invest interstate. I mean, we know that Sydney is really at the top of the market, and Melbourne's certainly approaching it, if not already there. Doesn't mean you can't buy in Sydney or buy in Melbourne. There's definitely opportunities in all those markets. But if you're just starting out and you're looking to get into a growth area, there there are other areas that Peter can think about.
And I'm sure, Peter, too, if you email Margaret at yourmoneyyourcall@destiny.com.au, that's yourmoneyyourcall@destiny.com.au, she'll be able to help you also with a broker that she will recommend for you. So, I think it would be remiss, gentlemen, if we didn't speak about the budget.
Oh, absolutely.
That's about to be
Unveiled tomorrow night.
unveiled tomorrow night. And the potential, I guess, or the impact of what that might mean for first home buyers and also for investors. You know, Ben, we were talking outside about a few of those things, potential stamp duty adjustments. I guess, what are your top three that you think, if we're going to speculate this evening?
Top three, speculation. Well, I think it's very clear we're going to have a ghost tax. So a ghost tax is a tax that's going to be put on properties that are resting vacant. So part of Scott Morrison and the Liberal Party's drive is not only to look at affordability from home ownership point of view, but also from a rental affordability point of view. So if we've got all these properties vacant from maybe foreign owners, then we're absolutely going to see some type of ghost tax, I think they're going to call it. So that's number one. Number two is going to be this superannuation concession. So it's not a superannuation concession, but an income concession to save for a deposit. And I think this is actually sensible policy, because what we see if policymakers come out with a grant or a bonus or something, everything's, you know, that's just going to go straight to the vendor who's selling the property. I don't disagree with that, but if we're starting to encourage people to save a deposit, because that is the hardest part, the value of property has grown considerably, so to have a 20% deposit, it's going to be hard work. Now, we're absolutely going to hear people coming out and say it's a silly idea, it's going to add to demand. But it's not as if these people are going to be able to save that deposit in 9 months. And if they did, they're going to have enormous incomes to be able to do that anyway. So if this is something that gradually allows people to save up a deposit over 3 or 5 years so they can enter the market, all power to them. I think that is sensible, and that should alleviate this commentary from millennials who are saying it's near impossible to get into the market on paying too much tax. So I don't mind that one. The third one, obviously no change to negative gearing or capital gains exemption. So that's good news for me, because those types of policy changes are what we talked about before, which is a sledgehammer into the property market, which could have dire consequences to the broader economy. I mean, I am interested in people being employed so they can save up their money to actually go out and buy a property, but I'm also interested in helping Australians invest in property to create wealth for a passive income. So bringing big changes to those two policies is quite dangerous for the broader valuation of property and also for the overall economy.
Yeah, okay. That's great. I think there's quite a bit in there for us to discuss. What we might do is do that when we come back from the break. So far tonight, a great night, but we have so much more lined up for you, including more chat on the budget speculation that we have tonight. But it's time for a quick break, and we'll be back soon. If you do have a question for us, call us and join the queue on 1300 30 34 35 or email property@skynews.com.au. You never know, you could win the question of the week. We'll be right back. Well, if you've just tuned in, there's still plenty of time for you to call and join in on the discussion. Tonight, Rich Harvey from Property Buyer and Ben Kingsley from Empower Wealth are here, and they're ready to help you. So call us now on 1300 30 34 35, or you can email us at property@skynews.com.au. And we have another caller, and it's Cyrus. Cyrus, you're from Sydney, and you're asking about units in Parramatta. Hello, Cyrus.
Yes, Hello.
Hello.
Yes, I wanted to know. Hello.
Hello.
Yes, I wanted to know your opinion.
Yes.
Regarding the Parramatta and Western Sydney, with the recent interest of the government expanding in that area, infrastructure, and also interest in the roads and trains in those areas. What is your opinion? Is it advisable to go after some units in Parramatta area or the houses?
Okay, I'll go to the panel for you, Cyrus, and we'll get their opinion. Okay, over to you, Rich.
Right.
What do you think about Parramatta?
Look, Parramatta is really like a Sydney's second CBD. It's got a lot of economic activity. It's being transformed. It's a really thriving centre. So, but despite the buzz, I would just say, Cyrus, be very careful about buying brand new apartments in Parramatta. That's not something I would be advocating. I'd be looking at areas, further afield like Westmead, and even then I wouldn't be buying apartments. I'd be buying townhouses, or if you can afford them, houses. And Lisa, the thing he's mentioned about infrastructure, there is a huge amount of infrastructure going on out there. In that Westmead precinct, where you've got Westmead Hospital, Westmead Children's Hospital, and a range of other medical facilities there are 50,000 jobs going to be created in the next decade. That's a huge number, 50,000 jobs. So that's going to spin off a lot of benefits. If you go further west than that, you've obviously got Badgerys Creek Airport, you've got the North West Rail Link, you've got West Connects, you've got a range of other road projects that are occurring. So I think it's a very broad question, but I think if you're going to sort of compare units or houses, if you can afford to buy houses and get something in an area that's got higher density, good zoning density, then go for it. But I wouldn't be buying units in Parramatta.
Well, Ben, it's all about what the demand is. What do people want? Do families want a home? Do they, is it single people? Is it retired folks?
Yeah, it is, and I think definitely it's got a bright future, but it's also about timing. In terms of Cyrus. So what I'd be saying is there is a right time and a wrong time to go into these types of markets. Now, we absolutely know, we can see the amount of cranes, we can see all the ground that's been brought to ground zero again, but I tend to agree that when it comes to supply, we can bring on high-rise and medium-density apartments very quickly, and sometimes we can bring on too many of them. So when we time the market at the wrong time, we're going to basically see very, very sluggish growth. If we're talking about townhouses and houses, totally agree. At the end of the day, we're not creating any more land there. So if we can get our hands on those townhouses or those freestanding houses, that's the gold. That's where the gold's going to be. But it obviously comes at a premium. And, when we talk about the type of accommodation that they're going to build out there, I encourage all the developers to start looking at 3 and 4 bedroom apartments as opposed to just the standard 1 and 2 bedrooms, because there will be families who will want to live in those locations, but you've got to be able to create that supply. If you don't do that, then you are going to get this sort of transient community that's going to live there, or it's going to be a stepping stone. So for me, I absolutely think I'll always go for houses first, townhouses seconds, villas, and then apartments in that order, based on the affordability story.
It's I just wonder whether the buying for Cyrus might be better somewhere else than Parramatta. Yes, he's looking at that infrastructure, and then sometimes that can get us excited, can't it? Well, we hope that helps you, Cyrus. We have another caller, and it's Debbie from WA. And Debbie, you've got a question on Dunsborough, is that right, and East Perth?
Yes, hello to the panel, and thank you for having a call.
Pleasure.
I have a investment property in East Perth, not far from where the Claysbrook Cove is and the new stadium that they're building, and it's a townhouse. It's not an apartment. There's an oversupply of houses in Perth, but there seems to be a pretty good location. Not that I'm thinking of selling, but I'm just wondering whether what the panel thinks of the potential there. And I've got a home and investment property in Dunsborough, very close to the beach, with ocean views in the old Dunsborough area. And even though the country areas are a little bit quiet right now we're having a bit of a run, and I'm just wondering what the thoughts are of WA, and if there's a bit of a movement in the mining, which there seems to be a little bit with employing, taking on new staff. So, I'll be interested to hear what happens.
Debbie, are you looking to hold both of those properties?
Well, just probably looking at a couple of decisions to make, whether to embark which investment property. I've got a home here, but which investment property maybe to hold, or should we hold it and maybe build something little, or whatever, or maybe just stick with shares for a while.
Okay, all right. Well, I'll go to the panel and see what they think about Perth. I'll go to you first, if that's okay, Ben.
Sure. Thanks for the call, Debbie. Really appreciate it. So East Perth is, for me, an absolute hold, especially given it's a townhouse. So what you'll see with that whole precinct redevelopment that's going on there, its proximity to town, and also the village that you're going to see around that East Perth area, for me that is a long-term hold, and I think you'll have no trouble in keeping that townhouse letted, and I expect to see some growth as the confidence comes back into the Perth market. Now, what we have seen, obviously, with the mining boom slowdown is the situation where the capex has dropped out. That's obviously caused confidence and sentiment shift in a marketplace that had a terrific run during that mining boom. Now, from that has obviously caused some lower population growth, and when we've seen that lower population growth, but that supply story in units and also houses coming into that market, we've got an imbalance, and that's what's caused the correction in the Perth market. Now, when we move down to areas like Dunsborough, which is a beautiful part of the world, and I'll put my hand up and say I got married there. It's a beautiful part of the world. It's great, and obviously ocean views, and certainly there's no doubt that that whole coastline, that beautiful Western Australian coastline, has the livability and the lifestyle drivers. The biggest question with that whole pocket, however, is going to be where are those jobs coming from, and where is that higher jobs going to come from? So where are those higher disposable income jobs coming from to keep pushing the value of property higher? So I can't comment on your particular property itself because that's impossible, but what I will say is I want to see to make sure that there is some jobs, some decentralisation of government going down into that pocket of the market, and then, you know, sort of seeing those six-figure salary jobs going there. Or it's going to be that fly-in, fly-out, that FIFO, that's going to be critical to keep supporting the value of properties in their area. It is a rich tourism area, beautiful wine district. All of those things tell me that it's got some, again, lovely appeal, but right now I would still say that that's probably going to underperform in the short term given the economic climate in Western Australia at the moment.
Interesting. I think just to add to that, you know, I can't comment specifically, having been married in that particular pocket, but I can imagine you had a lovely ceremony there. But Debbie, I think more the principle about whether you buy, whether you sell or whether you hold is sort of a broader question. I think just as a general principle, the way to evaluate that is, as Ben sort of pointed out, what are the growth drivers for that area? If the growth drivers are a lot more jobs coming, a lot more infrastructure coming and population growth, those three factors, population, jobs and infrastructure, if those things are going to be funneling into that area, you're going to see dramatic growth, you definitely hold. However, if it's going to be a really slow burner, a slow performer, you've got to look at the opportunity cost of holding that property. And it might be the case that, you know what, you've made a bit of a gain, it might be time to actually exit that property, recycle some equity, and even though you pay a selling fee to get out, recycle it and get into something that's really going to perform. So you need to do those numbers yourself or get some help for that, but that's the advice I'd generally be giving.
You know, we get often asked about Perth so many times here, and I think that if wishing for a market to improve was anything to impact a market, we would have that market going crazy.
We're not far off, Lisa. It's not. I mean, if we look at, so what we have seen is supply increase around 20 to 25%. Now, yields have come off around 20 to 25% as well. So once we start to see that absorption of some of that supply, that's a turning market. And for people like us who are professionals at what we do, that's the first sign that we would start to look at that market. I mean, at the end of the day, the art of investing in property is counter-cyclical. So you want to, if you've got a long-term view on property, and I'm talking 15, 20 years, these are the types of markets. So you might get in 18 months earlier, but you don't have that competition that's pushing those prices up. So you want to be greedy when others are fearful and fearful when others are greedy. So that is a good time to start looking at that Perth market. So I think we're probably still 12 months away from that, but that's what you want to be, just seeing how much of that supply is being absorbed, how the confidence is going over there, jobs, obviously iron ore prices, oil prices, it's a mining town, a big one at that, you know, and what's happening there and the confidence in the general economy. Once you start to see that happening, it's definitely going to be a market we'll be talking about probably this time next year.
Well, I hope so. I hope that is the case. So now, before the break, we were speculating on what might happen as the budget's handed down tomorrow night, which is Tuesday night. And so we had your top three.
We did.
There, Ben. I'm going to you now, Rich. What, if we're speculating further, what are your thoughts?
Well, I believe there is some speculation around helping downsizers exit their home and possibly having some contribution of whatever their sale proceeds to be put into their super. So I think the figure is around about $100,000 could be extracted from the sale of your oversized home, and you can put that into your super, which will be outside of the $1.6 million cap on your superannuation. So it's a good way. I think it's a sensible policy in the sense that we do need to free up more housing stock. We do have a lot of people sitting in very large homes that feel kind of trapped, and they do want to move, but they don't have any impetus to move. There's no incentive to move. So if we can create some incentives to that, because we need to see the next generation come through, and that's going to stimulate. When we get more transactions, when we get more trade in the property market, it benefits and flows through the whole economy. Agents love it because they get paid commissions. Developers like it because they get to build more homes. Builders like it because they're employing more people. So it really helps to free up the housing stock. But the biggest impediments, as we know, is stamp duty and other sorts of taxes. I mean, honestly, we need a whole of government review of tax. We can have a big discussion around this.
Oh, totally.
Let's get on that.
Yeah.
But I think
how long have we got?
But I think it's certainly one policy that can certainly help. And I think there's a lot more policies on the supply side that could be improved.
Yeah, absolutely. Do we think there's going to be anything in relation to self-managed super funds? I don't know, Ben. Are you thinking that there might be something happening around those?
Look, we've seen the Labor Party come out with their policy, which will ban gearing inside a Smurf. And so when they start banning that type of thing, then again, that's going to obviously affect some of the level of demand. But if you see the Labor Party doing that, maybe you won't see the Liberal Party making any changes soon in that particular space. And look, I'm a big believer in a free market. I don't like to see macro-prudential regulation coming into the marketplace. And I think that, if people want to look after their own super savings, they should have every right to do that. Now, if a business or a big super fund can invest into businesses that have got gearing like BHP, why can't someone who's a sophisticated investor also have the ability to look after their own affairs? The biggest problem is that, unfortunately, there's some people out there who don't do it in the best interest of the client or spruik to these people to set up these self-managed super funds. So that's obviously where government needs to try and protect those consumers. But on the whole, I do think that you shouldn't just then come in and blanket ban the ability to borrow money. I think there's people out there who are sensible investors who are doing it. I'm putting my hand up. I'm one of those people to be able to leverage into property through their super funds.
Right.
So do you think that overall, on Tuesday night, we'll be sitting back going, I think for property investors, this is a very positive budget from what you're hearing?
I don't think it's going to be a very positive budget. I think nothing's going to massively change that's going to make it fantastically positive. I think it'll be kind of more business as usual with a few things done on the side. Yeah. As we've talked about, we've got the ghost tax, we've got hopefully the concession for downsizers, but I don't think there's anything dramatic. They're not banning negative gearing. The idea of the Liberals tampering with self-managed super funds, I don't think they'll do that. So I think it'll be a fairly, nonplussed kind of budget in terms of property.
Well, let's keep our fingers crossed.
Probably a relief, to be honest.
I know, exactly.
It could have been a disaster if we do see, the Greens and Labor Party play with negative gearing, play with capital gains. That they are very, very serious regulatory changes that have market impact.
What really bugs me is when I worked in government, when you wanted to make a little change, you had to do a massive cost-benefit analysis for these changes. But some of these minor parties come out and say, let's ban negative gearing without looking at the widespread consequence of such a massive change. And I just think it's immoral to bring in such massive changes that affects so many people's livelihood just on a whim because they think it's the scapegoat.
Especially when they can't model the consequence. No. I mean, the Grattan Institute have modelled the consequence of 2% of the value of property. Now, in my maths, in my head, if we've got a $6.7 trillion marketplace, is 2% $134 billion? Because if it is that, who wants their property prices to go down by some portion of that? Exactly. And the fact of the matter is, with a secondary market, you're not going to see that just be 2% across the board. If everyone said, I'm putting my hand up for 2% so we can let some more people buy property, but it's not going to be like that. There's going to be markets that are really disturbed.
And it means that I think we can not be on the edge of our seat as the budget comes down this week. So that's a good thing. Well, thanks for tuning in tonight. It's time for a break, but when we return, you'll have another chance to get a copy of Margaret's book, How to Achieve Property Success. But you'll have to ask a question and have it selected. Simply call now on 1300 30 34 35, or you can also email us on property@skynews.com.au. We'll be back shortly. Welcome back to the property edition of Your Money, Your Call. I'm Lisa Montgomery, and joining me this evening is Rich Harvey from Property Buyer and Ben Kingsley from Empower Wealth. I'm sure you have a question for us, so grab the phone and dial 1300 30 34 35 or email us on property@skynews.com.au. And we're going to go straight to another email, and this one is from Jerry. And Jerry is writing to us, and he says the latest newsletter from SQM Research states that they expect an oversupply of new dwellings in Brisbane in the short to medium term. They expect an oversupply of inner city apartments of 5,000 and an oversupply of 9,000 suburban houses. That's a total of 14,000 dwellings. Population growth has slowed to 1.4% per annum, and rental yields are also falling. Now, SQM has proven to be a reliable forecaster in the past, and they are expecting house prices to fall in late 2018. What does the panel think? Now, often we might have Louis Christopher on the show. Shame he's not here tonight. But Brisbane is one of those questions we get every show. Rich, what are your thoughts about this?
Look, I think in terms of Jerry, units, yes, I think there's certain pockets where there's definitely be some oversupply. Places like West End, Fortitude Valley, just on some of those outskirts of the CBD there, I think they'll definitely be oversupplied. And we're already seeing rentals severely compressed in those areas. It's taking sometimes up to 3 months for, I know, some off-the-plan developments there where investors have been struggling to rent them out. Houses, I've got to say, it's more debatable. I think with houses, look, it could be 9,000, but I don't see a massive oversupply in houses because I think there's higher demand for that, and I think that'll be absorbed. Even if it is an oversupply, I think it will be more temporarily absorbed. Having said that, there's still plenty of good opportunities to buy in the Brisbane market.
Yeah.
You know, we're buying there every day of the week. We're buying houses there for between 3 to 500k. We're getting around a 6%, 5.5% yield, and when we throw a granny flat in the backyard, we're getting that yield up to 8%.
Yeah.
You know, and with duplexes as well, we're getting around that 6.5%, even 7% yield. So there's definitely opportunities in that market. So I think the oversupply issue is localised, and you've just got to do your research to know which suburbs to avoid and which suburbs to target.
Absolutely. You know, Ben, I was listening to Margaret speak earlier this evening. She wasn't in person because she's presently on an overseas trip, but she was talking about, you know, Logan is still some great buying in there, and also the Moreton Bay Shire. Do you concur with that?
Look, we've decided not to go into that particular market. Purely based on a couple of factors. Is there's still a bit of greenfield land, and the amount of investors that have gone into that particular market for us sort of puts the equilibrium out of balance a bit for us. We like to see 70-30 owner-occupier investor, so we've decided to sort of keep away from those main sort of, I mean, Logan Shire's a huge shire, but we'll keep away from those areas because we think it'll overrun itself. We think there might be a bit of pullback in prices in those particular areas. So, and we absolutely believe that the CBD is cooked. So, you know, we are seeing some developers postpone coming out of the ground, which we think is sensible. So from that point of view, it is going to take a while for that absorption to occur. I mean, what is going to be the biggest story for the Brisbane market is going to be the actual economy. And what are they doing about the southeast Queensland economy to get that moving again? You know, we know of stories of you know, general administrative jobs where 60 to 70 applicants for, you know, general office duties jobs are going at the moment, and that's concerning for us. So that's the one we want to just see what's going to happen in terms of what's going to drive that growth and that story of the economy. And if it's a good story, I don't think property prices will fall by that much, but if it's a small story, I think we've got a little bit to worry about.
Look, I think there's so many differing opinions about that area, and it's not just one area. There's so many different pockets, so I think we've really got to keep that in perspective. So we've got another email now, and it's from David. And David says, I have an investment property, an apartment in Burwood, New South Wales, which I purchased for $300,000, and it's now worth $600,000. Well, that's a great thing. It has a mortgage of around $90,000 and is currently rented at $410 per week. My question is, what is your criteria for selling a property? When do you make the decision to take your capital gains and invest elsewhere? Ooh, a big one. Rich Harvey?
Great question. I love this question.
Great question.
I get asked this question all the time. So it's a fairly simple answer in a way, but it also clearly depends on David's personal situation. So the first thing I would say is you only ever sell a property if you believe the long-term prospects for growth are very poor. I generally advocate holding properties for long-term, forever if you can. unless you're in that sort of, de-accumulation phase,
Yes.
selling out at the end of your retirement. Otherwise, hold it, because look at the transaction costs. You've spent money getting into the property, you've paid your stamp duty and your other fees to get into it. You're going to have to pay selling fees getting out. So really, if you can ride out the cycle, and I think Burwood's a great area. Look, Burwood's a attractive area. It's got a lot going for it. You've got a train station. You've got other infrastructure happening around that area. So I would advise probably him to hold on to it, look at refinancing and recycle that refinanceable equity into something else.
Yeah. What do you think about that yield that he's got on that?
Oh, it's terrific when you've only got a $90,000 debt.
Yeah.
And if you look at it from the original purchase price of $300,000 and you're getting $410, I mean, a great rental yield is usually $1 per thousand.
Yeah.
We'd all be happy with that every day of the week, and he's obviously getting better than that. That's
right.
So, I mean, there's two stories there. The one is the equity release story. So, do some reading around, David, do some reading around what equity is and how you release it and how you use cash flow and sensible leverage to not get yourself into too much trouble. But if you're still in the accumulation phase, that would be something. So I'm singing from the same hymn book as Rich tonight.
Very good.
In the sense that this is buy, hold, and we build on that.
Well, I think that's good advice for David, because that's a mighty fine property. I wouldn't be selling it anytime soon. So before we go, we've got a few minutes, and I just wanted to pick your brains, shall we say, just about getting value post-boom. There's a lot of people out there in the street, they'll come up to me and say, Lisa, we just don't know what to do. We don't know how to get any value. We've got a couple of minutes. Rich, how do you find value post-boom?
Another question I'm asked every day of the week.
Every day of the week.
Because you're creating value going forward. We've got a situation now where we've had a massive increase. Simple answer is you've got to look at a long-term perspective. So don't expect to get massive growth in the next couple of years. So moderate your growth expectation. Second thing to do is look at ways to add value. So it might be through a renovation. It might be just simply stripping out the carpet and floorboards and redoing the kitchen. That's a fairly simple reno. It might be adding a bedroom. It might be adding a granny flat, and that's a brilliant way to create more cash flow. It might be actually undertaking a building project from scratch. So there's other ways, and you can do them. They sound like they're really big projects, but they can actually be fairly simple if you've got the right help to get along the way.
You've got 20 seconds.
There are cycles within cycles, markets within markets. So don't think that we've got a one big property market. If it's down in one side, it's got to be up in another area. So look to be a boardless investor, Lisa.
Absolutely. Well, that brings us to the end of tonight's show. Many thanks to my two wonderful expert guests this evening, Rich Harvey from Property Buyer and Ben Kingsley from Empower Wealth. They'll be back on the show again very soon. Thanks also to our callers and emailers tonight. This week, our two questions of the week go to Cyrus, who called in about the units in Parramatta, and Christy, who emailed about investing in Waterloo. So if you both like to email me on lisa@lisamontgomery.com.au. That's lisa@lisamontgomery.com.au. I'll send you your books. You can follow me on Twitter @LisaKnowsMoney, and make sure you tune in next week for another great show where I'll be joined by Brad Beer from BMT Tax Depreciation and Ian Rodriguez from Bishop Collins. Thanks for tuning in to Sky News Money. Enjoy your evening.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.